The investing world is a wild west, and the oversaturation of gurus preaching and embellishing the value of cryptocurrencies and risky stocks isn't helping. The complicated nature of investing has facilitated an opportunity for experienced investors to take advantage of beginners with false promises of unrealistic returns. However, despite what these gurus and mentors say, investing is a relatively simple process. And so, today we will explain precisely how you can begin investing in the stock market, taking you all the way from learning to earning. Stick around until the end to find out about a stock that we think will blow up soon. Welcome to Money Psychology. Step 1. Save more money. Regardless of who you are or where you are, the first step every person must take in their investing journey is to begin saving money. Now, everyone's situation is different, so the amount you will be able to save will be different compared to those around you. Therefore, saving at least 10% of your income is a good rule of thumb. Everyone's income is different, so here is a small graph to illustrate exactly how this will look. $1,000 income equals $100 savings. $10,000 income equals $1,000 of savings. $100,000 income? $10,000 of savings. At first, 10% of your income might not seem like a lot, but in time, this will grow into a pool of wealth that can provide you with a foundation for sustainable, long-term investing. Step 2. Spend less money. The next step in your pursuit of successful investing is to reduce your expenses to have more savings at your disposal. To do this, we recommend categorizing your expenses into 2 sections: essential and non-essential. Here is a small graph to illustrate the 2 concepts. Essential: living, transport, groceries. Non-essential: entertainment, subscriptions, takeaways. We first recommend reducing your non-essential expenses before ultimately trying to reduce your essential as well. Now, while lowering your expenses is necessary, it's crucial that you are realistic with yourself and don't wholly neglect what you love. Find a balance that allows you to enjoy your life while making high-quality financial choices. At this point, with a solid foundation of savings and a healthy mindset around money, you will be well on your way to successfully investing in the stock market. Step 3. Invest your money. Before investing in stocks, the golden rule is time in the market, not timing the market. This rule essentially means that you should always focus on long-term investments that will provide time-tested, steady returns. As Warren Buffett, one of the most prolific investors of the 20th century, said, "If you aren't willing to own a stock for 10 years, don't bother owning it for 10 minutes." One of the best ways to invest long-term is through what is known as the S&P 500, which is a United States-based index fund that includes the top 500 companies within the country. In simple terms, an index fund is a group of stocks that are spread out across multiple industries and companies. That way, your risk is diversified, and you are less likely to incur a significant loss when a specific company drops in value. Index funds typically provide great returns over the long term, with the S&P 500 producing an annualized return of 12.34% since its conception in the early 20th century. Over time, you can then begin to capitalize on what is known as compound interest, which is where you earn interest on what you have invested on top of previously made interest, which can exponentially increase the longer you choose to invest. Compound interest is the reason you should always focus on long-term investing. To illustrate this point, here is a short story about Donald Trump. In 1996, Donald Trump inherited just over $400 million from his father. Today, he is worth $2.5 billion. The interesting part of this story is that if Donald Trump had invested that money into the S&P 500, he would now be worth $3 billion. That's right. If Donald had just invested that money and done nothing for the next 25 years, he would be worth $500 million more than he is now. If one of the most successful business people in the world is constantly beaten by the market, what makes you think you could? While index funds are a fantastic vehicle for investing, singular stocks can also provide a lucrative means for building wealth. Once again, you must invest in stocks that will give you a long-term return on your investment. The key here is to focus on companies that have succeeded through multiple recessions and are capable of constant expansion. Examples of this include companies like Amazon, Apple, and Google, to name a few. Over the years, personal finance has become convoluted through complicated financial jargon and gurus preaching the next big cash cow. The key lesson from this video is that building wealth is a simple process, provided you take your time, develop great habits, and value long-term investments. If you have a favorite index fund or stock, let us know in the comment section below, as we would love to hear from you. And if you enjoyed today's video, make sure to like and subscribe so we can continue providing you with ongoing finance-related content. Now, for those who stayed till the end of the video, here is a secret stock that we believe will provide a great return on your investment over the long term. Tesla. Through constant innovation and a CEO willing to push the limits on what is possible, we feel that Tesla will continually increase in value in the future. This is Money Psychology. Thanks for watching.